Hey business warriors, and welcome to this video. And today we're going to go through 5 stocks that I own. Now, before we get into the video, let's just make a couple of announcements. First of all, this is not financial advice. Don't buy any of these stocks just because I own them. You've got to do your own research. This is merely sharing with you what I'm doing, and you can get some ideas from it or whatever. But ultimately, if you're looking for financial advice, go and contact a financial advisor or do your own research or whatever. In addition, in a stock portfolio, I always do recommend that you put quite a large portion of your portfolio into ETFs and funds, okay, or index funds, tracking the market, so you can get that diversification. And this is what I do. About 50% of my portfolio is actually in various different ETFs that track the S&P 500 and several global markets as well. So just to put that out there, these stocks that I own make up 50% or less of the portfolio. Okay, so with that kind of disclaimer out there, let's get started. So the number one that we are going to talk about is Catepiller, ticker symbol CAT. Now, this stock is a cyclical stock. If you don't know, cyclical stocks generally go up and down with the fortunes of the economy, and they have a sort of cycle, okay? And investors generally, like, if a cyclical stock is doing well, making huge profits, it kind of takes more than that for investors to really jump on the bandwagon and get in there. So Catepiller is a good example. Right now, their earnings doubled in 2017, and on guidance, their earnings were up 70%. In 2018, okay? So they've been pulling in record profits, actually raised their dividend and stuff, but they are now down from their high of $173 about a year ago. As of today, I believe they are trading at $132 per share. And you know, you can see that they've come down with the overall stock market, okay? I bought in at about 145. So, and I bought in about a year ago. So I have been in and out of the green or the red, you know, in and out of profit with this over the last year, currently down on it by a few dollars per share, but I'm still confident about this company. We'll get into one of the reasons in just a moment. First of all, we'll talk about the dividend. They pay a dividend of 2.64%, and if you know anything about me, generally the stocks I invest in, I like to see a reasonable dividend. If I want a stock that's going to give me growth, I'm willing to accept a lower dividend, and in rare cases, no dividend at all. But then in other cases, I do like to try and get some nice dividends just to offset losses that possibly will happen just with the rise and fall of the overall economy. With this particular dividend, so we're looking at 2.64%. And their payout ratio is 30%. So out of their, you know, total earnings per share, they're only paying out 30% of the money that they are bringing in, which is definitely good. It's healthy. If you've got a company that's like 80 or 90% payout, they don't have much room. They probably will end up decreasing their dividend, you know, once they hit on hard times or whatever. That'll be the first thing to go when they need money to sustain the company, right? They won't be able to pay as big a dividend. But that Catepiller dividend, very safe, and they have increased their dividend for the last 5 quarters. Now, let's talk about number 2. The second stock I own is Rio Tinto, ticker symbol RIO. And this company, it's an Anglo-Australian mining company. I think their main headquarters is in London, but they actually do have a sort of secondary headquarters in Australia, and a huge amount of their business is in Australia. So they operate a weird structure. It's kind of like they are, the headquarters in Australia manages their Australian division just because it's so big, and then the London headquarters manages their international mining operations. And they do a lot of trade in iron ore. Iron ore is like one of their main products. Now, I am up massively on this stock. I bought it way back in 2016, before the whole rally of late 2016, 2017, after the election of President Trump. And this is actually the second time I invested in this company. I invested in them about 10 years ago, coming out of the financial crisis, sort of maybe 2010 kind of time. I made quite a bit of money on it back then. At the moment, they pay a dividend of 6%, which is more than rival companies, for example, BHP Billiton and other mining companies. So they pay quite a healthy dividend. Payout ratio is about 50%, so not quite as safe as the Catepiller dividend. Like with the Catepiller stock, this is a cyclical stock, so it does kind of go up and down with the economy. You know, mining is cyclical. But you know, one of Trump's campaign promises was a $1 trillion infrastructure spending bill. Now, that doesn't look, I don't think it's going to be $1 trillion if it happens at all, but it does look like that could still be on the cards, some kind of an infrastructure spending bill, because, you know, the Democrats now have the House, so probably a lot of other legislation that Trump wants to push through won't be popular, like the border wall that you see now with the government shutdown going on over that. But an infrastructure spending bill could be popular with both Democrats and Republicans. Democrats tend to want to spend more, although Republicans don't really seem to keep track of their spending either these days. But the Democrats are certainly known to be more about spending. So you could see a bipartisan infrastructure spending bill. I don't think it's going to be $1 trillion, but you know, the low 100 billions, it is possible we could see that. And in those cases, if there's a lot of building of roads, bridges, airports and stuff in the US, companies like Rio Tinto that manufacture iron ore, and also Catepiller, which we mentioned in the first stock, companies like that will benefit. So this is the reason I hang on to Rio Tinto and to Catepiller. But with Rio Tinto, I have recognized that what many analysts kind of think is that mining has kind of might be at the peak of its kind of super cycle, right? Beginning, and this was happening in the beginning of 2018. So I actually took the initiative and sold out a large amount of my stock in Rio Tinto at the beginning of 2018. So at the beginning of 2018, it had risen, I'd made a lot of money on it, and it actually had risen so much that it then took up 28% of my portfolio. So I wanted to rebalance. I don't want 28% in just one stock, okay? It's not diversified. And so on January 25th, I actually sold out 18 percentage points of that. So I took it down to just 10% of my portfolio. And I sold out at about $56 per share, just off the 3-year high. And I invested quite a bit of that money in our next stock. Number 3, Apple, ticker symbol AAPL. Now, this is obviously a tech company, requires no introduction, and I first bought into Apple at $163 a share back in February 2018, just after I'd sold out of Rio Tinto, and when Apple had conveniently suffered a small correction, quite a big drop in its share price, and yeah, I was able to buy the dip and buy into Apple back then. Then Apple went up massively in 2018, and it hit a high of $233 around September, October time, 2018. And so I was up massively on this stock, right? But then sadly, in recent months, it suffered a major correction, as with all of the tech sector really, and has now dropped back down below the price I bought it for. Now, I think we may have found a bottom for Apple now, and it is probably coming back up. But the reasons for this massive drop, well, they revised down their guidance on iPhone sales. Sales have been weakening, and you don't really need to be a sort of PhD in economics or anything like that to realize this. The replacement cycle for iPhones is getting longer and longer. I've got the iPhone 6. Look, there's the iPhone 6, right? And it's not even a 6S, it's just an iPhone 6. And I don't really consider replacing it anytime soon. The reason is, when they come out with each new generation of iPhone, you want to see if it's got new features, right? So when I upgraded from the 3 to the 5 and then from the 5 to the 6, they really did have some new features that I wanted. The 3 to the 5, it was, the screen was much more high resolution, much more nice to look at. 5 to the 6, less so, but it was nicer. And now 6 to the 7S or whatever it is, or 10X or whatever, it's not a significant jump. So people aren't upgrading as quickly. And Apple tried with the iPhone 10 to sell it for $1,000 or whatever. They thought they had pricing power, okay, because they're such a well-known brand. But sales have still been weakening, so maybe that's not really the case. And yeah, I think this is something that Apple is going to have to face up to and deal with if they want that stock price to increase. They are doing well though with their services, side of things, Apple Music, all that kind of stuff. That is growing very rapidly. So we have seen them kind of making a transition in some ways from hardware focused to hardware and services, which is definitely a very good move. I think Tim Cook, he's not really the creative genius that Steve Jobs was in terms of products. Okay, the only real new product under him has been the Apple Watch, which has been a reasonably warm reception, but you know, not so many people really need the watch as need the phone, right? It's not going to be as big a thing. But where Tim Cook does shine is he is a good businessman. He has led the company well since Steve Jobs left. So I do, you know, I do believe in him. I do believe in the company. I want to see them making more strides in that services area, and perhaps they do need a little bit of an adjustment to their business model with the iPhone, you know, area. I'm thinking that it's just overpriced a little bit. They didn't quite have the pricing power they thought they had. And Apple, of course, it also pays a dividend, so that ticks a box for me, and I do plan on holding this company long term. I think they're not going to fizzle out just yet. They are still, you know, one of the best companies in the US and a must for anyone's portfolio. Number 4, it's another tech company, Facebook, ticker symbol FB. Now, Facebook, obviously they own the Facebook website. They also own Instagram, which has been one of the fastest growing, or the fastest growing social media platform of 2018 and 2017. They also own WhatsApp Messenger, and then some other smaller companies like Oculus, the VR headset, you know, company. But you know, their 3 main things are the Facebook apps, Facebook website, WhatsApp, and Instagram. Okay. Now, Facebook has suffered a massive drop in its stock price in 2018. Now, I bought in just about here at $177, just after observing how the company exited a similar dip just here. Okay, stock price dipped, but it rose up again. I was hoping the same thing would happen, but I didn't quite time the bottom well enough. I didn't find the bottom. And well, you can see the stock has gone down even more. Went down into the 130s, which was quite scary because it had lost, well, almost like 50% of its value at that point. Almost, not quite. But it has come back up, and I'm thinking possibly we have found the bottom. Facebook is still, you know, massively profitable. They're making huge amounts of money. But the problem is they've been hit with scandal after scandal in terms of privacy issues, okay? So at the beginning of the year, you had that whole Cambridge Analytica thing, which I don't really quite understand what the problem with that was. It's kind of complicated, you know. To me, if you put something online, it's not going to be secure. Even if it's so-called private, only your friends can see it. I know they're selling that information. I mean, it happens all the time. It happens every single, like, I go and get a credit card from one company, a couple of days, you know, a few weeks later, I start getting junk mail from a load of other companies. I know they're selling my information, and logically, it's just going to be the same with Facebook. They're definitely selling information. I don't care, because things that I really want to keep private, I just don't put online. Write it down on a piece of paper, guys, come on. But obviously not everyone has that same opinion. Some people do expect that if you put something on Facebook or whatever, it remains private. And so we have seen, you know, Mark Zuckerberg testifying on Capitol Hill, and the EU getting involved, coming in with new regulations, all this kind of stuff, which has really hurt Facebook's stock price. But the fact is the company does remain very profitable. They're consistently beating earnings, and if they can just get rid of a lot of this negative press stuff, you know, a lot of funds sold out of Facebook, a lot of pension funds, etc. But if they can exit this this kind of zone that they're in, where it's constant negative press, I do believe that they will do well in the future. I think they're transitioning now to more of a value stock rather than a growth stock, a pure growth stock. So making that transition, I don't think there's going to be the same explosive growth in the future, but I definitely think this is a company that's going to do well into the future, and I will consider increasing my position in this while it's still on sale, as it were. Number 5, Tesla, ticker symbol TSLA, obviously Elon Musk's electric car company, and this is the last stock I'm going to talk about today, but this is going to be fun. So there was a lot of drama involved with Tesla last year, and in this stock I've actually been in and out of it, well, I've been in it twice. So the first time I bought it, I made a swing trade, excuse me. Swing trade, if you don't know, it's when a stock goes down, suddenly you buy the dip, wait for it to go up again, and then sell it. That's called a swing trade, and you make a little bit of a profit off that, you know, sudden sort of, you know, the dip. Normally you buy it when there's some negative news, okay? For example, Rolls-Royce a few years ago had some engine problems with some of its planes. Stock price dipped, but it's a solid company. They sorted it out. Stock price went up after a couple of weeks or whatever. So people bought the dip, sold out afterwards. Or some people just use it as an entry point for long-term investing, buying the dip, getting a little bit better value. But anyway, so buying it low, selling it high, it's called a swing trade. So I first bought this stock on July 31st at $294, and that was just before the famous considering taking Tesla private at 420, funding secured tweet from Elon Musk, okay, and this caused the stock price to rapidly shoot up, and after 8 days I sold out at $374, okay. Now I was watching Financial Education at the same time as this, and it was Jeremy from Financial Education that kind of gave me the idea to buy Tesla in the first place. He was buying it, and I was like, I'll weigh it up. Yeah, okay, I'll come in on that one. I'm going to buy that one. He actually sold out of it first, because he has a thing he doesn't like to, he doesn't want to buy private companies. Understandable. I held on to it for a few more days, but I eventually sold out 9 days after I bought it and made a healthy profit, $294 up to $374. But then, a few weeks later, Tesla finally announced that it wasn't going to go private after all. And then the SEC got involved, thinking that Elon Musk had defrauded investors and stuff, broken rules or whatever. And so that tanked the stock price and it went back down again. So I bought back in on September 7th at $262. And shortly after that, the SEC reached an agreement with Elon Musk on October 10th. And he was allowed to remain the CEO, but he had to step down as chairman of the board. He had to pay a $20 million fine. And with that being settled, and then Tesla reported earnings and revealed their first profitable quarter for 2 years, Q3 of 2018, was profitable. The stock price shot back up again, and it shot up to, it's now at $334. It has been higher than that. And so, I've been in and out, and it's doing great. So I'm very, very pleased, and I'm going to hold Tesla long term. When I first bought it, I intended to hold it long term. Because they were going private, after weighing it up, looking at what other people were doing and kind of weighing it up for myself, making my own decision, I decided to go out. But as soon as they decided they were not going to go private and their stock price dipped again, I was right back in there. And so yeah, I do agree, I do believe in that company, and I am holding it long term. So guys, those are 5 stocks that I own, and at the moment, those are actually the only individual stocks I own. Everything else is in various types of funds. Typically, I like no one stock to take up more than 10% of my portfolio. That's kind of a rule I go by. In doing investing, you can have rules for yourself. Many funds, like hedge funds and mutual funds, go by rules. They have rules set for themselves, like one individual stock can't take up, so much percentage of the portfolio, or they have to pay a dividend of at least this much, or something like that. And so I have rules for myself. One is that in general, I only invest in dividend-paying stocks, with very few exceptions. Tesla and Facebook are the exceptions, and it's quite high for me to have that many stocks that don't pay dividends at the moment. All of the funds I'm in pay dividends, by the way. So that's 80% of my portfolio pays dividends. And then the other thing for me is that I don't want one individual stock to take up more than 10% of my portfolio. So those are kind of the rules I go by. Guys, don't just buy these stocks because I bought them, okay? There are real issues with just buying stocks that other people buy, all right? It's good to listen and see what other people are doing to get ideas from it, just like I often watch Financial Education, look at what Jeremy's doing, but I will not follow him blindly, okay? Neither will I follow any other, investor or person blindly. Even Warren Buffett, I wouldn't just mimic what he's doing, okay? I mean, if you wanted to mimic what he's doing, you could just buy shares of his Berkshire Hathaway company already. So it's very specific to each investor, and you've got to have the same thinking if you're going to buy the same stocks as someone else, okay? You don't really know what they're thinking, what their risk management is doing, what their long-term goals are, etc. So it's best to have your own plan. There are a lot of reasons why you shouldn't buy the same stocks as someone else. I think I'll do another video on this in the future, maybe next week, because there's actually kind of a lot you can talk about in terms of the strategy and stuff, why you have to have your own plan. But guys, what do you think of this set of stocks? Do you think they are solid, or do you think I'm crazy and I'm going to lose all my money? I'd love to hear what you thought. Please leave a comment below. As always, please subscribe for more business and investing videos every week. We'll see you next time. Bye-bye.